Today we're going to explore some rising tensions in the Middle East, what Israel's bombing of Iran, and then Iran bombing Israel, what that means, because anytime Middle Eastern fighting increases, there's a risk to oil. We'll talk about the Straits of Hormuz, etc. But before we get to that, make sure you hit that subscribe button so that you're aware of videos that come out. They can be very educational. Hit that notification bell so that you know when one is released. Now, the bombings that took place. So on June 13th, Israel came in and struck over 100 targets, and their focus was certainly on nuclear sites. They do not feel comfortable with Iran increasing their nuclear capabilities, and frankly, I don't blame them for that. Now, Iran is an interesting area. Strategically, it's on the north coast, right at the Straits of Hormuz, and this is a major hub where oil and liquefied natural gas and all these things are shipped. And so anytime Iran is mixed up in some conflict, the immediate focus becomes on less energy supply. First of all, Iran is a big producer of energy, of oil and other energy sources. But secondly, they control that area, and there's so much that's shipped through there. It's just not as economically feasible to ship things and not use that waterway. So anytime tensions go up, this is why when Iran is in the mix, people really worry about what could happen with the oil market. So you had analysts coming out today saying, look, if tensions continue to escalate, if this becomes a full-on knockdown, drag-out war, oil prices are probably going to triple digits, back up to 100. But today's reaction was more short covering. It was just the initial reaction, right? There's some fear. Anyone that was short oil is covering those shorts, etc. And so today's pop is not necessarily the start of a massive uptrend. It really depends upon how things escalate. Now, Israel came out with the first bombings. Iran has since retaliated. And anytime there's international conflict, of course, then you start to question, well, how does the U.S. get involved? What about Russia? What about Europe? How do things escalate? What are the next dominoes to fall? And a lot of times, let me say that it's not as bad as it initially seems. So, of course, there's always that initial fear, that initial concern. But this is not the first time that Israel has bombed Iran. This is not the first time that Iran has sent missiles towards Israel. So this is nothing brand new. This is an ongoing conflict that continues to escalate. And the question is, how bad will it get in the shorter term? So those are the questions as a market participant we need to answer, because we need to think about how volatility is going to progress from here, whether things are going to get worse or calm to a certain extent. Now, oil popped, and it popped sharply. Oil was the big mover today. The S&P was down 1%. Gold prices were up 1.5%, 1%, but oil was up 8%. So it was clearly the outlier. It was clearly the commodity that was most in focus. And you saw some energy stocks certainly trade up. You saw gold mining stocks trade up with gold. And gold is kind of interesting because it has that defensive quality. But if you look at it technically, it's way better looking on a chart than oil. Oil has been down in this downward trend, and at best we'd say, well, it's consolidating sideways. But gold, on the other hand, and the gold mining stocks are truly have consolidated and are breaking out once again towards new all-time highs. And one thing that I always emphasize is, remember, sometimes when a price goes to a new all-time high, you think, oh, it's too high in price. Actually, it's not a good idea to buy at new all-time highs. It's a great idea. If you were to go back and look at historical studies of buying when things break out to new all-time highs, usually a new all-time high is met with more and more and more new all-time highs. So think about the S&P 500. When it broke out to new all-time highs at various intervals, it usually accelerates before it calms and pulls back in price and so on. So if you're looking at it from a technical perspective, from a trading perspective, things that are making new highs are bullish, and they have that, very simply, they have demand coming in. The asset is under demand and continuing to push higher. So that's what we saw for a one-day event in oil. But the gold markets and gold mining stocks, boy, they've been outperformers for some time. So that's a little bit what's happening in the conflict. Here at the Cashflow Academy, we're always looking to stack income. So how might we profit from this? Well, for me personally, I'm going to look at energy-related assets and see what type of opportunities they present. So what is impacted in the energy markets? What are being impacted in the gold or gold mining? For me personally, I rolled some calls up in the gold miners. For example, I had some covered calls in Newmont Mining or Barrick Gold or some different positions that I have, and I rolled the calls up, which means as those stocks are accelerating, I bought back the shorter term call, rolled up to a higher strike price, give myself more room and more leeway. We'll see if that's the right call, but ultimately it's a good risk management strategy, because as these things are breaking to new highs, they'll probably accelerate in the shorter term. Hope you've enjoyed this video. Remember to hit that subscribe button, hit the notification bell, and look for more videos from us here at the Cashflow Academy. We're trying to share and spread as much good education as we possibly can to make you a more well-informed investor, and we'll see you next time.